if you looked at my first promissory note that I signed for the seller contract, my handwriting was so scribbly. The signature, I mean, it was not very great. I was so nervous signing for $1 million loan, but being nervous is not a reason not to do it.
Welcome to episode 5 of the Real Estate Junkie Podcast. Today's episode comes with a bit of a twist. Our audio is a bit out of whack, but stick with us because the content is fantastic. Our guest is a familiar face to some, having made a splash on the BiggerPockets podcast at just 21. He's Cody Davis, an extraordinary young real estate investor. Now 23, Cody is on the cusp of owning almost 250 units, leveraging seller financing. I've dubbed him Cody the Kid, capturing his innovative and youthful spirit in the world of real estate. Get ready for an insightful and engaging session. So Cody, man, welcome to my show. I'm really glad to get you on here.
Yeah. Glad we could make this happen.
Yeah. Sounds like you've been pretty busy lately, huh?
Yeah. Just went under contract on a 33-plex, a quadplex, and a 15. And my very first RV park. So that's exciting.
You're going to have to definitely dive in a little bit on that. But let's just to start things off, there's probably a lot of listeners that are familiar with your story. I mean, you made a big splash couple years back on BiggerPockets. I think you built your portfolio up to like 80 units by the time you were 19 years old or something like that?
I had 81 rentals at 21 years old.
At 21?
Yeah, at 19, I had my first 12-plex.
So that was your first deal, was at 19?
Yep, dropped out of college, was coaching as gymnastics coach, and I bought a seller finance $0 out of pocket 12-plex.
And how old are you now?
23.
23. And how many units do you have today? Counting the ones you're under contract on.
Yeah, because I'm going to close those out. I'll be a little north of 250.
Wow. 23 years old, north of 250. That's crazy. And the fact that it sounds like the majority of these that you've picked up, you've used, creative financing, seller financing.
Yeah, never purchased with a bank to this day. And the deals that I'm buying right now are not even with a bank.
Never, not even one deal, huh?
Not one.
That is awesome. It's crazy because most people don't even know about seller financing. And they get super confused when you start talking about it. And like I stumbled across it myself when I was first diving into real estate. I like somehow went down that rabbit hole for tax liens, and I picked up a vacant residential lot on a tax auction in Aptos, California, and I thought I was getting a killer deal because I picked it up for $10,000. And It was like literally sandwiched between a property that was worth $750 here and another property that was worth like $800,000 here. And I thought, oh man, I just struck a gold mine. But lo and behold, when I went to see what it would take to actually build there, I found out that there was some endangered salamander or something like that in the area, so you couldn't build there. And so I was like, great, I just spent $10,000 for this useless lot. And so I'm searching, online, trying to figure out what can I do with this? How can I, recover from this? And it was only $10,000, but back then that was a lot to me. And I stumbled into seller financing, and I heard that more land deals are done with seller financing than anything else. And I also discovered that some people just want to own a chunk of land. Maybe they just want to set up a tent there. They just want to park there. They just want to own something. So I said, let me throw this out on Zillow and just see if I can fetch something. And I did. I found someone that wanted to do it, and I I hired an attorney. We wrote it up, ended up selling it for $35,000, 10% down, right? And then now, even to this day, I'm collecting a check every month from this guy. So I fell in love with seller financing at that point. And I'm like, okay, man, this is a path not only for me to eventually, once my properties are all paid off, possibly offer that to new investors, or, like I heard your story that, working with people that want to give you a chance, want to help you get to where they are. So I thought of that. And I also thought, wow, I could actually use this to kind of get around the banks, beat some of these interest rates. And so I've done a few seller financing deals since then, on purchases. But for you to actually start out that way and build out your whole portfolio is pretty incredible. So I got to hear your story. I want to hear your genesis. Like, did you come from a family that was like all about real estate, or like, how did you fall into real estate in the first place?
That would have been helpful, but getting started, I'm the first generation in my family tree to buy anything other than a house. And so I am first person to ever buy anything, to ever rent out, first person to get my real estate license, to be in property management. Didn't get any guidance on that other than don't do it. My family said go to college, which I did. But after 2 quarters, I dropped out. I decided that's not my path. And so they guided me away from it. Eventually, I got a 12-plex. They said, okay, but you're $1 million in debt now. Be careful. And then I got another $1 million in debt. And then fast forward 2 years from that, I think I was up to $7 million in debt or something like that. And today it's over 15. As of end of January, I should be closer to 18, 19. But they got more confidence as I came along, and it's been a journey of meeting up with folks who have done what I wanted to do, finding them online, just random people that own real estate that if I dropped their name, you and I would not both know them. They're not the famous people, but just folks that I got started a long time ago and learned a thing or two along the way.
So how did you go, especially initially though, how did you go about finding these folks that were willing to do these types of transactions in the first place?
Well, I didn't even know that this was a thing. And so I was a real estate agent, like I mentioned, and not a good one. I wasn't making any money. However, there was someone else in the office and they were making pretty good money. I think their first deal, the commission was over $100,000. And they did it. They got a referral from someone else in the real estate business because they weren't local. And so after splits and after everything, they walked away with like $40,000 in their first month. And here I was 6 months in and didn't make anything. Well, at that 6-month mark, that individual was brokering a deal, and it was 12-plex, a 6-plex, and a 4-plex package. There's 22 units over in a little place called Moses Lake. And the deal was seller financed. It was $1.4 million, $300,000 down, and it was going to net cash flow like $8,000 a month. So the buyer for that client was going to borrow the down payment at 12% interest, and they were going to net cash flow $5,000 a month with upside. And so they were pursuing it, and that's the first time I heard about a couple things. First time I heard about seller financing. First time I realized you could borrow for a down payment. First time I heard about Moses Lake or buying apartments like that. I was told you get started with the duplex, triplex, fourplex, rich dad, poor dad. You figure out how to get your assets to pay for themselves, and maybe you get an FHA and figure out how to get the down payment. That's where I was coming from. So I got all these new ideas, and the buyer that was going to close that deal, their funding source, there was a private money lender that liked to work with the brokerage I was at. They didn't want to fund the down payment for that buyer anymore. They were going to just be a slumlord. They didn't want to do any work on it. They definitely weren't going to do any of the work themselves. So the owner of the brokerage said, well, Cody, why don't you buy it? And I said, well, I've got about 300,000 reasons I can't buy it. His down payment's $300,000. And when I realized that, there goes the cat. When I realized that he was telling me that, hey, you should try and borrow it. If you do the work yourself, you get out there, you start working hard, can probably set up this loan. And it was basically going to be hard money or a money shark, because everyone back then was borrowing at 3-4%. I was going to be borrowing at 12 for the down payment. I said, okay, let's do it. And I thought I just had this deal that fell on my lap that was going to cash flow $5,000 a month. Well, the previous buyer had strung it along again and again and again. And so we needed a 1-week extension to get everything done. I thought I was going to be the rich kid that was going to be a millionaire at 19, cash flowing $60,000 a year. And the seller didn't grant the extension. They'd already been strung along. However, I was pretty bummed, because there was just like a lotto ticket falling in my lap.
Yeah.
What I did realize is, there's something here. If it could have been done once, maybe it could be done again. So I looked on the MLS and I found a 12-plex. It was listed with owner financing. Called them up and asked what the terms they wanted were, offered it, and they accepted. And it was 45, 60 days later, I closed that deal.
Wow. So the property that you found, you had a seller that wanted to do owner financing, right? Probably because they wanted to possibly negate some of the, the capital gains that they would have to pay, and have a passive income stream with no strings attached.
Yep.
Nice. But you were 19 years old though. So you walked in there and you were able to get their trust and everything. And did they know this was your very first deal?
They didn't. The way that you carry yourself goes a long ways. And I'm better at it today than I was back then. But I knew for a fact that they weren't going to trust me if I wasn't confident going into the conversation. I got it under contract before I met the brokers, before I met the owner, and at that point, the seller. And so I went in and said, hey, there's a 22-unit deal in Moses Lake. This was in Quincy, which is about 40 minutes away. And I just let them know, hey, I had a 22-unit deal that just fell apart. I was working on it. It was seller finance. It's very similar to this. What are you thinking on terms? And from that conversation, the dialogue, let them know that I've been working on stuff in the area. That built trust.
Got it. And you said, and what were the terms on that first one? What was your down payment? Yeah.
So I bought it for $1,125,000. The seller financed 90% of the purchase. It was 6% interest loan, 30-year AM, no balloon. It's like a home loan. Just make the payment, it'll be paid off. It was great.
Yeah.
They didn't want to be paid off, and so they did a 15% prepayment penalty for 6 years. So I got another 2 years on that, but prepayment penalty is $150K on $1 million loan. It's ridiculous. So I'm going to keep that loan for a little bit. But there was 10% down that I didn't have. And so I didn't get the money raised. It wasn't going to be that land in your lap type of deal like the first one was going to be. So I pitched everybody in the office, and I pitched all their clients that they gave me permission to pitch, and said, hey, I need a loan. I got the 90% lined up. I just need 10% down. This is the cash flow. And I botched those pitches over and over. First pitch, I was in front of whiteboard. I forgot the price, forgot the down payment, forgot the cash flow, the numbers, everything. And so I botched and struggled my way through those meetings. But over the course of a month, I got better and not perfect, but I landed a pitch with one of the other broker's clients. They funded the down payment in second position. And the asset, after paying all the bills and paying both mortgages to the seller and to the investor, cash flowed $800 a month.
Hey, a win is a win.
It is. But then it came down to, okay, I bought real estate. How do I never lose it? And that was the piece I had to figure out, how to keep really happy tenants. Happy tenants don't trash your buildings, and they pay if they can. And so I was able to keep as many tenants as I could. Nobody moved out in the first year. And then when someone did after that 12-month mark, I had to go in and I still got Facebook photos online of me going in and cleaning those units and getting them ready to re-rent. And over time, as people left, I'd make it a little bit nicer, rent it out for more. And today the rent roll is $5,000 a month more than it was when I bought it. And I paid off that down payment money. But what most people ask then is, well, how did you pay off the down payment? Because $800 a month doesn't pay off $125,000 down payment. I borrowed $125,000 instead of $112,500 because I figured I should have a little cushion, and I got to pay closing costs and all that. So that doesn't pay off the $125,000 I borrowed for the down. That's the reason that I kept pushing to buy more deals. So within 9 months of buying that, I bought a fixer-upper 12-plex. 9 months after that, I bought a 6-plex. And then in that year, I got up to 81 rentals. And that was when I was 21 years old. I had to go out and buy a bunch of stuff so that I made my big problems small problems. And I ended up getting more problems along the way, things I didn't know that I didn't know. There's a lot of that out there for everybody.
Yes.
But I was able to overcome the down payments that I borrowed because I bought enough quick enough, and I built enough relationships with owners in that market to where if I needed a deal or I had to go get a value add project, I could call up an owner that I'd meet. And these people were 3 hours away from where I grew up. I didn't know them prior, but I could call them up and say, hey, I'm looking for this. And because I'd been building those relationships, they'd give it to me, and I'd get the value add opportunities to get the value up. And then I could basically move a loan from one property to another because I could borrow cash out with a hard money loan against another asset, get the monies for myself, and pay off the original one. And that set new timelines until I had a big enough net worth to get bank loans.
Nice. So now is that your strategy? Are you refinancing out of the seller financing, or on some of them anyway, the ones that you can, and moving to bank loans?
Some of them. I have some notes that aren't worth refinancing. I bought a resort with my buddy Christian, and that was seller finance. We bought that with $0 out of our own pocket. And that has a 4.5% interest rate. There's no reason to refinance that. Got another deal that's 15 years of 5% interest only. There's no reason to refinance that one. I can't beat those terms. And so while they have a lot of equity and I could pull money out, it would kill the cash flow. And I don't particularly want to do that on all those deals. So I've got some cash flow deals where there's lower leverage because I got the value add, but I didn't re-lever it. And then I've got other deals that don't cash flow as much, but I pulled a bunch of money out to stabilize everything else. And it's good to have a balance of both so that you have income coming in and you've got some cash in the bank so that you can weather some of these storms.
So let me ask you, you said you started out as a real estate agent and you weren't a very good one. And then you kind of fell into the investment side and you obviously had a knack for it. And I'm curious though, what gave you the tenacity that I see that you have, that drive to just go up and do these things? I mean, these are hard things. A lot of people would be scared to even tackle, but you jumped right in. Like where does that come from?
I started listening to a lot of YouTube videos of people that had gone big, and I'm not going to name drop some of the folks, but there's a lot of bigger folks in the real estate space that are on YouTube, and some of them are really loud and obnoxious and in your face. And the folks that are listening probably know who I'm talking about. But I listen to a lot of those folks talk about bigger goals and getting your mindset correct, adding a zero to things, thinking just that much bigger. And over the last few years, as I bought 2 properties, I ended up going to the real estate events and meeting with investors. I went to a real estate event. I got to have dinner with Robert Kiyosaki and Ken McElroy and meet with some of those folks and just discuss what I'm working on. And I haven't been super confident in the beginning. If you looked at my first promissory note that I signed for the seller contract, my handwriting was so scribbly. The signature, it was not very great. I was so nervous signing for $1 million loan, but being nervous is not a reason not to do it. And so I proceeded. And then as I started to buy some more stuff, I wasn't rich or wealthy. I mean, that doesn't happen. Usually it's like 5 to 10 years. You have to own this stuff for it to actually start really producing for you. That seems to be the case. And next year is going on 5 years. So I'm really excited because I'm starting to see the benefits from some of the first assets I purchased. But as I bought more, I got a little bit more confident. I got to meet with more people. And the more people I met with, the more confident I got because it gave me more opportunities to buy stuff. And it started to become a snowball. And the problem with that is folks that are getting started have the least amount of information and the least amount of confidence to go do this. But that's not a reason not to do it. That's a reason to do it and get started because it gets easier over time.
Yeah, absolutely it does. I mean, I always tell people when you want to talk about risk, the risky thing is like if you're owning rental properties, for example, the risky thing is owning one rental property, right? That's the most riskiest thing you could do. Owning 10, 100 is a lot less risky because the chances that you're going to have complete failure across your entire portfolio are pretty slim. So the bad ones or the good ones will make up for the bad ones. And at the end of the day, the more assets you have, I mean, worst case scenario, you could always start selling them, if you needed to.
I will caveat that you're right about small investors. Like the small investors are the ones that get slapped. But also the bigger you are, the more likely you are to make a mistake because you have more pieces on the board. You can drop some balls. And the people that really get slapped hard in real estate are the ones who stay really small. They're always susceptible to some stupid lawsuit. A frivolous lawsuit can wipe you out. Or the people that scale so quickly with short-term debt. It's easier to scale quickly with short-term debt than it is with long-term because you can get debt products that don't fit the conventional box where you probably wouldn't qualify normally. And so folks that scale too quickly with shorter-term balloons, they could have 400, 500, 600 units and they could be cash flowing, but they find themselves in a position where they've got all their balloons coming due at once. They didn't cash flow plan their exits properly, and now they lose a bunch of their stuff.
Yeah, interest rates are up, and they're in a bad situation. Absolutely. So let's talk a little bit about as far as raising the capital for the down payment. How did you structure that? Were they like? Talk to me about that. How were they structured in the deal?
Well, they were a second lien. They were not a partner, and that's the biggest difference. I'm not a fan of folks partnering with people they don't know. That's a good way to get slapped in real estate. I like to use that term because it's painful, but it won't kill you. And so you don't want to partner typically with people that you haven't had long-term relationships with. And sometimes they work, sometimes they don't. And more often they don't. So I borrowed the down payment. I put it in second lien. And I accidentally hit the 3 targets that I found to be consistently the only things that people care about. And I didn't know how to quantify it in the beginning because I was just figuring stuff out. But investors care about where's the money going, what's the stability of what's backing it, and how am I getting paid. And if you answer those 3 things, you're set. Now, it's not about the IRR. More so than people making money, they care about not losing money. And so you can map out what you're going to pay them or what the interest rate is, but really they care about where's it going, how stable is it, and how do I get paid. And so what I accidentally mapped out in the beginning was, hey, I've got this Quincy 12-plex. I'd show it to them on Google Maps. I couldn't afford any big software, so I just pull up a Google Street View. And so this is where it's going, super stable, next to the church, next to the Microsoft data centers. It's next to all these food processing plants, and there's a lot of jobs, and it's fully occupied. It's really stable, great location. And then how are you getting paid back? Well, the income's $10,000, and my mortgage is $6,000. I'm going to self-manage it. These are the expenses. It has this much cash flow to pay you and pay me, and we're good. And there was upside. So I showed him, hey, I could pay you back. And if I can't pay you off the $125 I borrow from you, I'll sign over the property. It's a 30-year fixed rate debt product. You can't get this with a bank. I'll sign it over instead of foreclosure. And you can have a great asset that cash flows even more, because I was making a margin. So your return goes up. And if I pay you off, you earn your 12% when everyone else is lending money out at 3%, and it's a win-win. But I didn't know how to quantify it back then. But those are the 3 things people care about if they're investing or lending money.
Well, plus I think once you've done, once these investors start working with you and they're getting paid back these great returns in full, they're going to want to invest with you again, right? Because they've built that trust. So now maybe the first run, they're like, okay, well, the most I want to trust this kid with is, $50K. But then the next time around, they might go, you know what? Let me put $200K in his hands and see what he can do with it.
It does scale like that. Yeah, I've done deals with 50. I've done deals with a couple hundred. Did a deal with $1 million. That was the resort. Someone gave us a check for $1 million. I was asking for 250 because I used to think ask what you think will get accepted versus asking what you need. And so I asked, hey, would you be down to do 250? We're trying to get 4 partners at 250 each for $1 million to buy this resort. And they said, well, what would it look like if we funded the whole down payment? I said, well, it'd look like a check for $1 million from you to me. And they said, okay. And that was a year, probably a year and 4 months ago, a year or 3 months ago. So I'd already been in real estate for a few years at that point. But it does scale over time. I didn't start with the resort, and I didn't start with some of these multifamilies, but it gets bigger over time. And if you can effectively manage your options, things you can do versus your obligations, things you have to do, over the long haul, you position yourself to be a much better investor and potential partner, whether it's a capital partner or a lending partner, on deals. But most people get too many obligations relative to the amount of options they have to do stuff, where they implode and they're less lendable. Even if they can pay out a good return on a deal, it's not scalable.
So let's talk about you overcoming a bad situation. I'm sure since you've been able to scale it as far as you have, you probably made some really bad decisions that you look back now and go, man, I wish I would have done this one differently. Can you share one of those stories with us?
I let someone else in my organization handle the money. And imagine that, they stole the money.
Really?
Oh, it happens. And it was a significant amount. And so without name calling or anything, they taught me a lot in the beginning, and I'm bummed things played out the way they did. It happened a couple of years ago. But it cost a lot of money. And so I had to readjust some of my real estate pieces. I didn't have to sell out of anything as far as actually selling properties, but I had to borrow more money than I wish I had to borrow to make ends meet. And it strained cash flow for a couple of years. And finally, as of just recently, I'm out of all that and things are feeling much better. But I trusted the wrong person to handle the money. And in the beginning, if I had to start over, I would have just made sure I oversaw all the accounts. I wasn't trusting blindly. Even someone that was double my age, had more experience, I shouldn't have given up that responsibility.
Well, that's definitely a life lesson. And even it was someone that you trusted. It's sad that so many friendships and even families have been torn apart over money.
Don't partner with family. I don't do that, but I've heard that doesn't go very well.
It doesn't go really well. You hear horror stories all the time, and I have family members always coming to me and going, "Hey, let's buy something together." And I'm like, I don't know about that, because I would hate for something bad to happen and then it breaks that bond that we have as a family.
Unless the money doesn't matter, because if the money didn't matter, if it was like a $40,000 deal and it was a drop in the bucket for you to cash them out if it didn't go well, then cool. But if it matters, don't do it.
Great advice. Great advice. So if you could go back to your 19-year-old self when you did your first deal, and you could sit in a room with yourself, what advice would you give yourself?
I would have bought more. I had other opportunities where I had the deal, I had the debt, the seller finance debt. I could have bought it with $0 out of pocket, and I would have hit $100,000 a year net cash flow a lot sooner. It would have been before I was 21. There was multiple deals in the area I could have bought. I thought, you know what, I should just buy one and figure this thing out. It's not that complicated once you own it. And I should have relied on the fact that I'm good at math. I understood the risk analysis that I did on it, and the cash flows that were coming in and the upside. There was a couple deals from the same owner that I could have bought all at once. And that would have significantly, it would have significantly impacted my trajectory. However, I made a good partnership along the way with my buddy Christian, so that this partnership may never have happened because I wouldn't have needed it. So I'm happy that things played out the way they did, but had I bought the deals I was looking at, because I had the deal lined up, the debt, it cash flowed, it was great, it was all seller financed, same owner, I just would have been so much further at that point, and I wouldn't have had to take on, like I mentioned earlier, options versus obligations. I would have had more options rather than obligations, which is what I ended up having at the end of everything.
Wow. So how are you managing all of these properties? Are you going through a third party, or are you managing things yourself?
I managed my first 30 rentals. And after that point in time, I bought a 38-plex with my buddy Christian. That's how we started our partnership. He was buying duplexes. He had 2 duplexes at the time, and he wanted to get 30 units. I said, let's buy a 38 and you'll be there tomorrow. And so that's what we did. We bought a seller finance, 0 down. At that point, we created a management company. And then we bought another 100 rentals and the hospitality stuff. And so we really started to grow that PM company, and I realized that I don't really want to have that job. I'm not interested in being a property manager. I'm not interested in being an owner of that company. So he traded me a 6-plex, and I traded him my ownership shares in that company we built, and that company manages all my stuff.
Nice. So what's your long-term vision? Like you mentioned in earlier when we first started that you just purchased your first RV park, right?
That's set to close in January. So I'm under contract buying that it's the reason I'm buying it. It's next to the resort we bought on the Hood Canal. And I think there's quite a bit of value add that can be done. And then we can sell it, pay the long-term cap gains tax, and just be liquid, like $800,000. And that is why I'm really interested in that deal, because there's a point where you don't need more real estate. You got your 3 buckets. You got your equity, your cash flow, and your cash. And the real estate builds equity and it produces cash flow, but it doesn't give me a bunch of cash right now. And at the moment, I don't need more real estate. So I'm trying to balance those 3 buckets. And so we're doing that as we'll hold it for a little over a year, sell it, and then pay the taxes, get the cash in, so that we can more balance out the portfolio that we're holding.
So you're looking at taking that income and then paying down loans and stuff to increase your cash flow?
Yeah, so we'll pay the taxes and have about 800 is the projection. And the thought is with the 800,000, we have a 4-stage business cycle. Your build phase where you go out and buy a bunch of stuff, you stabilize it, you get to consistent income and expenses, optimize it, which is highest and best use, and then pay it off. We're optimizing all of our real estate right now. And so my thought was, let's go get super liquid, get a couple million in the bank. And then that way, if anything comes up, cash is your first line of defense after insurance and everything to fix your problems if you have big problems that come up. And you need cash flow so that you never run out of all that money, but you need a buffer. And nobody starts with that buffer for the most part. I didn't. So we're trying to get that buffer right now of 7 figures in the bank so that we can make sure that we can fully optimize the portfolio. And once it's optimized, we got highest and best use. We don't have any impending capital expenditures we'd have to get rid of those to get to highest and best use. Now we can take all the cash flow and start hammering the debt. So we're a debt-free organization. And then we can choose to do what we want to do. And whether we want to go scale up on bigger apartment buildings, which is what we'll probably do, We're working on getting some 20, 30 plus unit deals right now. Stabilize those. We'll probably 1031 those up into 60 to 75 plus unit deals that will hold forever, and then pay them off. And if we had 10 of those, 10 60 unit deals, I don't know what we'd do from that point on, but that's what we're shooting for right now.
Sounds like most of these properties you're buying, are they mostly in Washington or?
Everything is, yeah.
Everything.
The hotels, the apartments, the RV park, it's all in Washington.
Okay. So is it just because you're familiar with this area, you like to be able to reach out and touch it, or like what's keeping you in Washington? Because I know from a as far as landlord friendly states go, it's not the friendliest.
It's not. Someone's going to own here. And whether there's difficulty or not with ownership, there's always going to be an opportunity for those who want it. And I started buying here. At this point in time, it would be almost impossible to sell all my stuff. Because how are you going to sell all these little buildings? That's the problem with little buildings. You can't exit them, right, if there's too many of them. So yeah, you could do a portfolio sale, but you're probably not going to get top dollar on something like that. And so the thought was, well, I already own here. I should start buying bigger stuff in the area, fix up the little stuff so all the communities are really nice. If there's no slums, once it's done, they're all fixed. So you fix up the little stuff. Meanwhile, figure out how to creatively buy the big stuff. And you got empty lots that come with some of your purchases, you can build them out and make the communities really nice. But that way, on the bigger stuff, eventually you sell the little properties, pay the taxes, take the money, and pay off the big stuff. And now you got a lot of really nice little neighborhoods of little properties. You got the duplexes, the sixplexes, the 12s. And then you go get the bigger properties and you just own those, and there's no more crappy properties around it. Because there's a lot of properties out there, a lot of neighborhoods where you can tell they've just been milking the property. They haven't been reinvesting into it. If you fix the neighborhood, once it's done, it's done. You have to trust the next person to maintain it, but it's much easier to maintain than it is to fix. And so we're going in and with all our little stuff, fixing it up. Eventually we'll sell it and use all those proceeds after paying the taxes, which is going to be a lot of money, but that's okay. That's what the money's for. Pay off all the debt on the big stuff, and then we're basically indestructible at that point.
Wow, you have an extremely big vision, and it's very inspiring. And I hope I have kids that are like your age and actually a little bit older, and I hope they're listening because I've been preaching to them. I got into real estate later in life, right? I dabbled in it, but I didn't really get too serious until about 6 years ago is when I really started building up my portfolio. But nowhere near what you're doing, which is incredible. So I could definitely learn from you. I hope my kids are listening right now so that they can plug in and get the wheels spinning in their ear. I understand you also have a mentorship program too.
We do. Yeah, we've got a YouTube channel and a mentorship. One's free, the other's not. But the mentorship stemmed out of the idea that I was posting YouTube videos, and folks can go way back. I was doing it on my phone, and it was really bad quality. But I was trying to put information out there, and I was learning, and I never took any of those videos down. And people kept asking me more questions, trying to do one-on-ones. And so my partner and I now, Christian, we opened up multifamilystrategy.com. How we got that domain, that was fortunate because we named our brand Multifamily Strategy, and someone had that domain and they didn't pay the subscription fee. So we picked it up for like $12 on auction. But we offer the mentorship there. We meet 3 times a week, every single week on Zoom. It's an hour each session, group setting. Used to do one-on-one, realized people did better when there was a group. And then for folks that don't have money to invest in that, we have a YouTube channel, which is called Cody and Christian Multifamily Strategy.
Nice. And so if for the listeners out there, I know your Instagram is at doing Cody things, and man, are you doing things, man? Just big things. So definitely, you definitely want to follow this young man. It's very inspiring. The fact that he even has a mentorship that you can tap into and learn some stuff from, maybe not make the mistakes that, he mentioned early on. I mean, the coolest thing about your story is that you didn't come from a real estate background. You didn't grow up like me. That's how it was for me. I mean, as a child, we moved from house to house to house, renting. No one owned anything. So I was like the first one to actually go, you know what, I'm going to start buying real estate. But it was so late in life. And the fact that you've done this so early in life, it's so remarkable. So I just really applaud you. And, everyone is out there, follow this young man. He's doing big things. I think I want to even give you a new nickname. I mean, you're like Cody the Kid, Billy the Kid in the Wild Wild West. He was a young gunslinger making a name for himself. That's exactly what you're doing in real estate, man. And it's real impressive. And I love the fact that you're not scared to jump in. And that's really what prevents a lot of people from doing anything. It's just taking that first step. And you weren't afraid to do that. You were nervous. Everyone is, right? But you tried your best to not let anyone know how scared you really were. And that's awesome. That's what it takes to succeed. It really is.
Well, I appreciate it. And I appreciate you having me on. This is fun.
Yeah, this was great, man. I thanks, Jason, for making this connection. Really appreciate it. It was great talking to you. I can't wait to see where you're going to be in the next couple years. I really can't.
Hopefully further than I am today.
Always making positive steps. I love the fact, though, that you're like, you know what? Instead of just concentrating on scale forever, let's put on the brakes. Let's start putting some safety measures in place.
Appreciate it. It's worth it to not have to play the game twice. So whatever it takes to build something worth building and then find a way to hold it forever. I mean, that's our whole strategy, is figure out how do you buy stuff and how do you never lose it. It's worth figuring out that second piece, because a lot of people, they just neglect that one. They don't spend enough time really thinking about how could I hold this forever and not be in a position where I'm going to lose it.
Smart. Very smart. You make money when you buy real estate, not when you sell it.
Yep. Make money on the buy, and you make it when you manage it better than everybody else.
There you go. All right, Cody. Thank you so much for spending this time with me, and I'll be watching you.
I appreciate it, Keith. Thank you.